Thank you, Chairman, and thank you, Mr. Walsh. You're very welcome. Did you see Brendan McDonagh's evidence to the committee?
I saw some, but I wouldn't have seen it all. Because
he said that his view on the night of the guarantee was that the society was insolvent, a broken institution, he called it. So what did you make of that? Or if this is the first time you're hearing it, what do you make of that?
I mean, to be blunt about it, I'm absolutely astonished by his evidence, or at least by that statement, because it was he who actually sent the email to Mr. Bosang in the Department of Finance, effectively that day, saying society had 3 billion and that the outflow from the society at that stage was 30 million, so multiple, because the reality is once the guarantee level had been increased to 100,000, the outflow from the society in terms of deposits actually went down dramatically. Because I think in the earlier part, before that increase, there was substantial outflows, which would have caused serious concerns in the middle of September. Once, I think it was September the 20th, that the increase in the guarantee went to the 100,000, that largely stopped. And as I said, the specific email, which as I say is sent from McDonagh to Bosang, says society has 3 billion, the outflows are 30. They are, for all practical purposes, in no immediate need of cash. They may have a need in December, and they may not. Now, if somebody is saying, they have all the cash they actually require, there is no short-term problem, they have potentially an issue coming up in December, but we don't know at this point in time, they may or they may not. I would have said it is pretty much irreconcilable for that and an insolvent situation to be put together. I just can't rationalise it.
Okay, so just to clarify that, essentially you think that the interaction that you had with the NTMA at the time contradicts the evidence then that Mr. McDonagh gave us in terms of his view at the time?
Sorry, I think I left it up in my bag, but I mean there's a very specific email which says, and I say this is going from McDonagh to Bosang saying the society has 3 billion in cash and its outflow is 30 million. And it has sufficient cash at the moment. We may need to consider a contingency plan for December. Now, so on any basis, at that point in time, it was absolutely solvent.
Okay, thank you. If I could then move on to the Project Harmony report. From 2003 to 2006, the Society's loan book trebled.
On that note, I'll just ask if Mr. Walsh at the end of today's proceedings could furnish the referenced email to the committee. Thank you.
The loan book trebles from 3.4 billion to 10.7 billion, driven mainly by commercial lending, as you know. Yep. Given the facts in the Harmony report and what we've seen about there not being a highly developed approach to risk assessment or sophisticated information system, I mean, is that growth rate prudent or sustainable?
Well, I think whether it is prudent or sustainable, at the end of the day, are two separate questions. I mean, no loans were actually made which the society didn't deem were actually prudent. Would it have been sustainable going forward? I think the reality is almost certainly no. And we all know with the benefit of hindsight it wouldn't have been. Clearly, those people who were interested in actually buying the society at the time, and I think you've got the names of a number of them, all believed the society was actually a good model and had good potential.
Interested in buying the society, but let's look at this idea of prudence. I mean, if they're saying that you do not have a highly developed approach to risk assessment, how can you judge a prudent decision?
Yeah, but sorry, how do you define a highly developed approach in the context of the type of business that society was actually doing? I mean, the society actually had a very simple business. It didn't need overly sophisticated systems or overly sophisticated.
Why would the report note this then? Why would this?
Because I think, very clearly, because in the event that the society or whoever acquired the society was going to diversify into other areas, they would have to consider the investment. I mean, the purpose of these reports is to say, look, this is what an organisation actually looks like. If you're coming in to buy it, this is what we're representing to you. So if you're going to come in and buy it to do what it's doing at the moment, that's one thing. If you're coming in to buy it to do something different, then you're going to have to make changes.
The relevance of those points, as in the Project Harmony, relate to if the buyer decides to diversify out of what you see as a very simple banking function up to that point in time.
But I mean, even KPMG, I think in 2008, described, the operation, the society as a very simple business. It was all in the one sort of place, very straightforward. So, yes, it was straightforward and simple. The reality is it was concentrated in property, and whether it had been residential property or construction or commercial, you would have had the exact same write-downs if you decided to market everything in 2009.
Okay. The final area I want to look at in the limited time I have is coming back to the regulator. Because one of the titles, subheadings in your written statement is lost opportunity. And you talk about the society reversing engines before any other institution. So when you decided to make that, when you made that decision in December 2007, and the regulator at the time was doing the 5x5 large exposure, large debtor connections in the individual institutions, so it had some awareness of the liquidity crisis that was developing in Irish banks. But you brought this to the regulator and said, we're making this decision out of prudence because we're not sure about the next year for Irish banking. And then what happened on the side of the regulator?
I would have said very little. Clearly there was correspondence during 2008, and to a degree, I suppose I always wondered whether there was an element of, shall we say, kind of moving the deck chairs. There was a problem that was actually systemic across the country. It should have been obvious for over a year, but it was a systemic problem. It wasn't a problem, with one institution or some small number of institutions. Those 2006 stress tests were saying 88%. So by definition, all the pillar banks had to be gone at that point in time. So it should have been an extraordinarily worrying situation for any regulator or central bank. Now, very clearly, liquidity was an issue that they were focusing on. I think we've actually heard that the domestic standing group, was putting in place contingency plans from the beginning of, I think, 2008. But I kind of can't actually reconcile. I went back to the regulator, as you know, in May. There was other correspondence in between, but primarily in May, and I said, look, you've got to take a leadership role. You had AIB there, and with due respect to AIB, they were actually sort of saying, we can't stop lending because we lose market share. Society was taking a decision, look, it may mean we lose market share, but this is the right thing to actually do. Now, from the regulator's point of view, they should have seen that it was the right thing for us to do. It should have been right across the system. And yet, you find that there's, I think, 3 billion property and construction lending by AIB during 2008. I don't, I'm sorry, I need to be very clear. I don't believe that all of the damage or anything close to all the damage could have been stopped at that stage. We were...
Mr. Deputy.
Yeah. Sorry. We were, at that point in time, you could have mitigated, and I don't even know what you could have done to really kind of sort it out. But, the problem was, if you really think about it, you get to September 2008, you've employed, Merrill Lynch a week before the night of the guarantee, and you're asking people who've been there for a week to advise you on the future of the country. We should have never got to that situation. Okay,
it's just then my final question is, so in your view, did the financial regulator ever take that leadership role?
No, I think it's very clear. You have my written statement in terms of my direct quotes as to what they needed to do. Because, from the society's point of view, it actually was, a decision we had taken, recognised the, implications of it. But, it was also clear that, there were competitive pressures still going on around the place. People were trying to actually suggest there was instability around. And they were doing that, obviously, for competitive advantage, because if money left the society, was going to go to one of the larger institutions, or indeed Northern Rock, which was actually seen as guaranteed by the UK government at the time. But the only way you were going to stamp that out or really get ahead of the curve was actually by the regulator, or not necessarily the regulator, the central bank, the Department of Finance, whoever actually taking a real role in terms of trying to deal with the crisis.
Okay, thank you.